Hey everyone, welcome back to our news trading session. And yeah, as I say, we are gonna do things slightly different this time around. And unlike the previous months, we do have a lot going on right now. So yeah, let's get started with our theory and practice sessions. And there's a lot to talk about, and we really need to kind of pay attention to what's news are going on in the market. In fact, I'm actually going to give you a little bit of an example of what actually happened yesterday. Just talk you down a little bit and guide you into in terms of what's really been happening in the market. Hopefully, you guys have been following what's going on in the market, and we'll get started tonight. Let me know if there's any audio issues. But other than that, my name is Vera and Jota. Let's get started with our theory and practice session. There's a lot to talk about. Okay, before we start, I want to go through with the disclaimer first. Any opinion discussed in this webinar or link to this presentation is provided as a general market commentary and does not constitute investment advice. News trading involves risk due to high volatility. Market reaction to news can be swift and unpredictable, which leads to high trading risks and delays in order executions. So be very attentive when determining the volume of your transactions and consider all possible risk factors. Okay, and especially true in terms of news trading, and I want to give you an example of news trading from yesterday that caused a lot of chaos in the market. You probably don't see the reaction too much in the currency market, but I'll try and match it out and see, just give you guys a little bit of comparison into stuff. All right, hello. Jesus is real, he is. Okay, just gonna give you a bonus for participants. There's gonna be a promo code to double your deposit bonus. I'm gonna show you the code after this. And then you should have access to the private Telegram channel if you have attended our news trading session before or registered through the website. If not, please get in touch with the customer service team from Octa and they will get you sorted on how to get to the Telegram channel. All right, so this is the code. It's non-farm 2025. This is to double the deposit bonus, and I believe this is a single-use code. So keep the codes. If you see codes like this from us during our webinars, just note it down. You never know when you're gonna need it, when you're depositing into your Octa trading accounts. Just make sure to get that double deposit bonus. It is valid until the 31st of December 2025. So keep the code. It's non-farm 2025. All right. So a little bit about myself. My name is Vera Njoro. If you have never attended my sessions before, and I've been a full-time trader with over 20 years of experience, exactly 23 years of experience. And I've been a professional trading coach and technical analyst since 2007 for a couple of, leaders in the FX brokerage industry. All right, my expertise is in the Ichimoku Kinko Hyo technique, which is a Japanese shorting techniques. And if you are curious, we do have a few videos. I think we do have a lot of videos on Ichimoku Kinko techniques on the Octa channel. So make sure you look it up on the Octa Broker channel. All right. I've been invited as a guest speaker at Trading and Investing Expo across Australia, where I'm based, Invest Fair in Singapore, as well as the ATA and the APTA conferences, which is Australian Technical Analysts Associations. Okay, so I'm going to go through things very quickly. Obviously, we'll talk about advantages, disadvantages, and whatnot, what are profitable news for trading and stuff like that. And then we'll get into how we actually trade the news. So we like to use pending orders, and I'm going to give you an example on how to kind of take advantage of using those. All right, but I really want to talk about what kind of news that we're looking at. Okay. All right, advantages and disadvantages first. I'm going to go through very quickly here first. All necessary information can be found in the economic calendar, so there's no need to delve deeply into technical and fundamental analysis. And let me just clarify, news trading is not fundamental analysis. It's a completely different thing. You can trade with technical, you can trade with fundamental knowledge, but when it comes to news trading, it's just a completely different thing just by itself, okay? So news trading is really more on the reaction of the market. It's really more on the sentiment of the market. If you can figure out the sentiment of the market, then you can trade the news very well. Do you need technical analysis? If you understand technical analysis, especially if you understand price actions analysis, then yeah, it will help you a lot. And we actually do have a lot of video on the smart money concept. We did that. And surprise, surprise, I think it was actually 2 years ago that we did this smart money concept there. But yeah, it's there. It's in the library. It's actually in the playlist. You can look it up if you go to YouTube and click on Octa Broker's channel, and you can actually search for SMC if you are curious and wants to learn more about price action analysis. I think it's really useful when it comes to niche trading. If you understand the structure of the market, where are the liquidities, and this kind of stuff does help a lot. But you need it. It helps if you have it. It's actually going to help you guys a lot. But if you are not, if you're new and you're still learning about all this stuff here, then you actually don't need to delve deeply into technical analysis to be able to trade news. As I said, news trading is completely different. Okay. Fundamental analysis, if you understand it, yes, it will help you a little bit, because then you can understand how the news is going to react, how the market is actually going to react to the news, based on the context of the fundamentals or the economics of the country itself. Okay. Now, the other advantage is that event calendars are ranked in order of importance, which helps in making adequate decisions. Publication of statistical reports noticeably increases volatility. This allows traders to potentially earn significant profits in a short period of time. And the strategy to this is actually very simple. To the point, it's actually really, really simple. You basically need to know how to open and close the orders without the need to learn any complex formulas, because we actually use a very specific trading strategy. For example, using the buy stop and sell stop, we use the straddle strategy to kind of get the breakouts in the market. It's very simple, and we'll go through that tonight. Okay. Minimal time expenditure on trading. So you know exactly when to access a trading platform, what actions to take, and the trading process itself, it's just a couple of minutes. In fact, when we do our live trading sessions, right, for the NFE numbers or the CPI numbers, which is CPI is going to be on the 10th, which is on Thursday, you'll be very surprised. It only takes us about 5 minutes to set up, a lot of the orders that we try to get. So it doesn't take very long, and as you get used to it, it gets even faster. It doesn't take half an hour. It doesn't take an hour to kind of figure out what move to take. Okay, so those are going to be the advantages. There are a couple of disadvantages, and I might actually add in a little bit of the disadvantages there as well. So number one, the market reaction to the situation doesn't develop as predicted, doesn't always develop as predicted, and sometimes it just doesn't click on the logical thinking side and the common sense. I think that's one disadvantage, just because news trading, again, let me just remind you on, specifically on news trading, what we're looking at here is actually the reaction of the market, right? We're looking at the sentiment on the market, what are traders thinking about. And sometimes it doesn't click, and sometimes it just doesn't make sense, because traders are probably going to be looking for, very specific things depending on the context, right? So taking a look at the NFP numbers that we saw last week. The NFP number was good. And does that cause a lot of movement in the market? It does strengthen the US dollar a little bit, but that wasn't the news that the market was looking for, right? Market last week, especially on the labor numbers, and we did talk about the Labor Day, the labor market, and I'll say that was, you're looking at day one of a potential financial crisis. And, we warned you about this since like 2 weeks ago or 3 weeks ago. And last Friday, when we did our non-farm payrolls, I said it's not going to have an impact onto the market. And that's basically what it is. We got a really good NFE numbers, right? It was mixed a little bit because the unemployment rate was a little bit higher, but it doesn't have an impact into the market. We don't see crazy volatility in the market on Friday, but we did, I did say that Friday was very special. And if you look at the recording last Friday, it was actually in a very different format. We kind of skip a lot on the theory and I actually break down and guide you on what's going on in the market. And one thing that I say was, it was day one that we're in the bear market, day one that we are potentially looking at a financial crisis in the market. Okay. And if you have been following up with the news, if you have been, keeping up with the market, you know that yesterday on Monday when the market opened. On a global scale, that was a bloodbath, right? The equity market was pretty much shaken up globally. The whole world was losing millions, billions, trillions of dollars, right? In just one single day. Whatever financial gains that was in the past 2 years got wiped out pretty much in the past 2 months. And the movement yesterday in terms of the volatility, in fact, the S&P 500, which is kind of the benchmark index for the US equity market, or what we call the Wall Street, basically, it basically recorded the highest volatility, which is higher than when it was COVID, right? So the volatility in the market yesterday was higher than when COVID hits. So just, the whole thing was unique, right? And we saw the market was basically red yesterday. We did see a little bit of a recovery last night and continuing to the global markets today. Everyone's just hopeful a little bit, but are we really off the market? Are we off the crisis at this point in time? It's probably not, because we officially technically went into a bear market. So yeah, that's one disadvantage on news trading. Sometimes it doesn't click. Good news, it's probably not what the market was looking for. Market, last week was looking for bad news in the market, because bad news in the market last week could actually be good news for a lot of traders, because the expectation here is that for the FOMC to have a reason to start cutting interest rates in the US. So I think that's one disadvantage for new traders coming into the market. If you don't understand fundamental analysis, if you're not really sure how to pick up what traders are looking out for, then it could actually be a disadvantage if you don't know what's going on. But if you understand the market, I don't think that's a disadvantage, right? So just keep that in mind. This is a disadvantage for new traders. Now, not all news can cause significant market reaction. This one here, again, I would agree with that. Sometimes we're just waiting for that news, and sometimes just nothing happens, right? Now, the major disadvantage here is if you're not able to accurately anticipate the market reaction and direction, or analyze the situation incorrectly, you may experience significant losses. So the advantage is that the volatility is so high that you can earn a lot in a short period of time. And with volatility, there's always going to be a flip side. So we are always going to be looking at people making the right decision, saying, hey, I made a lot of money in a short period of time. But if you make the wrong decisions, then you would actually lose a lot of money in a short period of time as well. So this high volatility, some people like it, some people don't like it. So it really depends on your, how you are as a trader. This could be a disadvantage, this could be an advantage. That's completely up to you. All right. Now I'm going to add one more disadvantages. Okay. This is probably more on, hot news, right? We're going to talk about the unexpected news. All right. This unexpected news do cause a lot of uncertainty to the market. It could heighten volatility, and that's basically what's been going on in the market. And I think that's a major disadvantage, especially if we know something's going to happen during the day, but we don't have a specific time for that. Then yeah, it becomes a disadvantage to news trading. So this is something that a lot of traders need to be careful about. And I want to add on to the disadvantage here is that you need to be constantly aware of what's going on in the financial market. Otherwise, you probably don't know what hits you. Okay, so in fact, I can give you an example very soon, but I want to talk about that example soon. All right, so in terms of profitable news for trading, so we want to talk about the two different categories for news. We have the hot unexpected news. It could include terrorist attack, military conflict, natural disasters. I want to add one more. We can add Trump into it right now. So the whole terror situations right now, it is currently hot news. It's unexpected. And I'm going to give you an example right here, right now. I want to show you what happened yesterday. I want you to take a look at this. This is actually on a 5-minute time frame, right? And let me see if I can zoom in here a little bit. This was last night. This was last night exactly. We're looking at GMT times. It's about 5 5 p.m. London time. So depending on your time frame, it could be late Asian sessions or whatever, right? But I want you to take a look at this. It looks like a very normal candle, right? We saw a bullish run to the upside, everything is fine. But let me just scale this into perspective. We had a rally from 3,723 on the Dow yesterday, all the way up to 39,229 in a period of less than 10 minutes. That is very high volatility, and let me just put it into perspective there. That's about 2,000 points. And 2,000 points on the movement in Dow Jones, right? It's crazy huge. That, the normal movement in the US 30 or the Dow Jones average, if nothing is happening in the market, if market is not in a panic mode or anything like that, it's very hard for Dow to exceed 1,000 in a day. All right, it's very hard for Dow to exceed 500 points or 750 points in a normal market condition. Yesterday, it spiked up. In less than 10 minutes, it hit 2,000 points. It went up by 2,000 points, and within the next 5 minutes after that, it didn't stay down. In fact, market just crashed down about 1,400 points. So, what causes this? There must be a reason why it got triggered like that. Well, apparently there was actually a fake news running around. Someone posted on Twitter that Donald Trump is going to be pausing the tariff for 90 days, and the market just automatically shot up because they were looking for any good news that Donald Trump doesn't implement the tariff, and then within 5-10 minutes, CNBC verified that the news was fake, and we had another sell-off in the market. So, that's one thing. These are unexpected news that could cause a lot of volatility in the market. So imagine this, right? Let me zoom out a little bit. Imagine this: if you were, you were looking at that, right? And this is on the hourly chart, and you're looking at the crash in the market. You were looking at the meltdown there. There was a huge gap on Monday morning when the market opened. It crashes down like that. And what if your technical says that, oh, it's in a downtrend, or you start to go into that panic selling mode and you start selling the market, and all of a sudden the market goes against you by 2,000 points, wipe you out, and then come back down within 5 minutes. Things like that happen, and that's part of news trading. If you get it right, obviously, if you get it right, then you're gonna make a lot of money. As simple as that, right? If you get it right, you made a lot of money in a short period of time. Less than 5 minutes, you're gonna be in and off the trade. It's actually very easy, right? If you take a look at it. Why? Because market was kind of building up a little bit of a resistance up there. So if you manage to figure it out and you understand the price action analysis, you probably had a stop order placed there. And it might trigger a buy position because the market was actually in a holding pattern a little bit. And in less than 3 minutes, you could be up 1,500 points on the Dow. And to put it simply, one single contract size is $1 in the Dow. So if you had 10 contract size, that's 15,000 times 10. That kind of stuff happens, right? But if you get it wrong, then you're going to be negative 1,500 points. But here's the problem. If you're not keeping in touch with what's going on in the world, and this unexpected news happens all around, you might be thinking, okay, all right, Trump pauses. Maybe you bought up there. And you started buying when the candle opens here, and then the news was verified to be fake, and you didn't know that it was fake. It just comes crashing down. You might get dragged down immediately by about 1,000 points to the downside. So there are risks involved when it comes to news trading, and especially with unexpected news, it could cause spikes like this in the market. But that unexpected news, even though it was fake news, it was enough to generate enough volume, enough momentum that people that don't follow news started to look at it from a technical perspective, and look at that and as a potential recovery in the market. You can see where the market is recovering right now, but it's stuck. All right, and this is why we want to look at the market structure into what's really going on. Okay, those are the example of the unexpected news. It can happen. It can happen in a very short period of time. Now, the stuff that we can monitor and we can predict to a certain degree, that's the periodic news, right? This are the one that comes out regularly. You know, this are scheduled every year. We know when the releases are. We know when the NFE is going to be released, what time it's actually going to be released, right? CPI is going to be on Thursday, that kind of stuff, right? We know all that because those are scheduled releases, right? You can take central bank meetings, you know, monetary policy decisions. Those are going to move the market. Quarterly GDP reports, those are going to move the market. CPI numbers, which is what we're going to be looking at on Thursday, the core CPI as well, you know, those are going to move the market, especially this Thursday is actually going to move a lot, the market a lot. It will have a huge impact into the market. The PPI on Friday, for example, we know when they are actually going to be released. All right, ISM manufacturing, you know, ISM services, this PMI numbers, you know, those are predictable schedules, right? So those are your periodic news. Those are the one that we want to trade, right? But you also need to be aware that unexpected news move the market a lot more in the market. It could cause a lot of panics in a short period of time. It could cause a huge volatility, a lot of uncertainty in the market. Those unexpected news, you know, tariff Trump announcement, it was worse than the worst case scenario. Those are unexpected news, right? Do we keep an eye on them? Of course, we keep an eye on them. In fact, we guide you with that from the outlook from, you know, last week, not even this week, right? But yeah, those are the stuff that we are keeping an eye on in terms of news, and they can be profitable if you get it right, if you know how to manage your positions, right? And if you know how to trade the market, especially price actions, then yeah, those are basically how you make your profits. Basically, to me, news are basically the catalyst for the market to start moving in one direction. If the market doesn't have any news, we typically have a flat day. Like for example, right now, you know, market is not reacting to any news. We don't have any news today. You know, market is just waiting for something unexpected to happen, you know, before, you know, something big happens in the market. We don't see huge volatility if no one is expecting any news. So just keep that in mind if you're thinking, hey, you know, I don't trade news. No, it's fine. If you don't trade the news, it's fine. But trust me on this, 23 years of trading, you need news to be the catalyst for the market to move. If there's no news in the market is just not going to move anywhere. Okay? So we need that catalyst. We need something for the market to start moving, or for the market to have that volatility. Remember, our job as a trader is to make friend with volatility and take advantage of that short-term volatility. Those are traders. If you're afraid of a volatile market, then you're not a trader. You're an investor. That's the difference between a trader and an investor. Traders always look for those volatility. In fact, they love those volatility. If there's no volatility, no point in trading, all right? Because the market is just going to move really, really slow. You're just going to be wasting your time. Simple as that. All right. So how does it work? Well, it's very simple. If we understand the three main phases of price movement, then we will understand what's really going on in the market last night, or what's been going on in the past 2 months, in fact. All right. And we have talked about this a lot. You know, there are accumulation phases, there are going to be participation phases, there's going to be distribution phases. You know, accumulation phases is basically when we see that range bound market condition. All right. Because, you know, a lot of traders look at that and say, hey, it's a range bound market condition. I'm not going to be trading in the market because the market is just moving up, down, up, down, up, down. It's not going anywhere. No, you get it wrong. If you see that kind of market condition, then you should consider two possible scenarios. Either the institutional funds or the smart monies are getting in, starting to layer their positions, or they're trying to get out from their positions. So this accumulation phases typically is the holding range before we see, you know, a run in the market. Before that happens, we will have the accumulation phase. And then participation phase is when the market starts breaking out. You know, if you're a technical trader, you understand, okay, this is where I get in. All right, very simple. So these are the two differences here. You know, the accumulation phase are people that understands the market. They're professional traders. All right, they have information, they have knowledge that, you know, retail traders that don't know. They get in before everyone gets in because they're trying to get in at the best price possible. They're trying to get in as low as possible, maybe near support or resistance. That's simple as that. Once the breakout happens, when everyone starts coming in into the trade, then their trade is profitable because they have been accumulating a lot of positions. Now, when everyone starts hearing what's going on, that's going to be a distribution phase. Why? Because it's you know, it's outdated information. The public, or you know, if in Wall Street language, we basically call it Main Street, right? If you don't understand Wall Street, then you're Main Street, right? If Main Street people heard about the news, then that's when we know the public is entering into the market. Everyone is panic selling, or everyone is trying to start buying, chasing after a trend or anything like that. You need to be a little bit more careful because that's what we call the distribution phase. That means the smart money is that comes in during the accumulation phase. When they see the market is rallying up really quickly, they get to their target really quickly as well. So they want to get out from their positions. So be very careful when you see the phases start to move really steeply in one direction, because then it would actually fall into a distribution phase. Now, this works for both ways. It can be looked at, the example here is obviously a bullish market, but you reverse this and it works in a bearish market. Now, I can give you an example on that phases as well. And unlike previous examples, we typically don't have that examples back then. But I'm going to show you on this one here, and let me show you what's going on in the index here, because this one here, it's the easiest to show you what's really going on. All right, so I'm trying to zoom in. Okay, I think this is the most zoom in position that I have right now. But yeah, you can see the collapse that happens in the market here. You know, before it drops down, you can see what's going on. You know, people are actually starting to accumulate positions and whatnot. The accumulation doesn't happen here, right? Let me just highlight a little bit. So just let me give you a little bit of an example here. The accumulation happens up top. That was the warning that I gave out in February. If you don't believe me, look it up. When we did our live trades and theory sessions in the month of February, we highlight this. We mentioned this, that there could actually be a potential fall in the stock market in Dow Jones, right? And you can see what's going on here. Everyone starts breaking out. This is the participation that happened in the market. This phase is the participation phase, right? And then it kind of cool off a little bit. And then it started dropping down really quickly. So if I reverse what we just talked about here and take a look at the example here, to a certain degree, we kind of gave out the hint, right, in February, that there could be an accumulation, that the market could actually potentially reverse. And then when it starts dropping down, technical traders saw that breakdown, they jump in on there. It becomes a participation phase, and then the last drop here is a distribution phase. Now, if you take a look at the end of the distribution phase here, you can see, I'm just trying to zoom in, and I think my keyboard, I think it just died on me. All right, so there you go. So this sharp move to the downside there, right? See what happens here? All of a sudden, market just bounces back up, right? So if you're chasing the trend on Monday, let's say you saw the market crashes on Monday, and then on Tuesday when the market opens, you start selling it, and then all of a sudden you got caught because you were late. You know, a lot of traders got caught on this one here. A lot of margin calls got triggered on Monday, so everyone thought, hey, you know, everyone is short selling it. Let me just short sell the index as well. And then on Tuesday, instead of continuing to go down, the market actually recovered. So this is actually, what we're looking at is actually a distribution phase in the market here. So people that shorted from up top, which is from here, they are getting out from their positions because that's a huge run. We'll be talking about, close to about 10,000 points on the Dow. That's unprecedented. It's actually really huge. 9,000 points on the Dow. That was huge, right? So you need to understand these three main phases. Otherwise, you're not going to be able to trade the news. As simple as that. And I can't stress out the importance of understanding this. And a lot of people just kind of ignore it because they thought all they need to understand is the market structure. Sure, market structure is one thing, but if you don't understand what price movements, what phases are they in, then you're going to be in a lot of trouble. All right. Okay. So before we go on to giving you the strategy here, just some general rules for news trading here. Just make sure you study the market and analyze the dynamics of the currency pair. Make sure you understand what you're trading. If you don't understand what you're trading, you need to be a little bit more careful because you can't just jump in and trade everything on news. You basically need to understand how the mechanics on that particular asset works. Now, you also need to assess the reaction of a certain currency pair to the latest news. And the example I just gave you, I gave you the US 30, which is an index that you can actually trade on your Octa trading accounts. If you didn't know, you can actually trade those equity market as well. You can trade the index itself. So do that, and also prepare trading by marking relevant levels on the chart before the news gets released. Decide on your trading tactics, including when to open and close the order. Choose an appropriate trading time frame. You're looking at it on the daily time frame, 15 minutes time frame, 5 minutes and a minute. Maybe even a tick. Doesn't matter, right? Just make sure you stick to one, because I saw people like to trade on the 5 minutes time frame. If I trade in an environment with high volatility, I even go down to 1 minute time frame, and that's completely fine. We use the right time frame depending on the situation there. So make sure you also determine the maximum risk for each order, and consider using stop losses and trading stop loss, because if you don't plan out your risk, then it's going to be problematic. If the market drags you out, you don't have a plan in terms of where to get out. It could just basically margin call your account. So let me just stress that out. And also decide on the term of the deal, right? Whether it's actually going to be a quick or long-term deal lasting 1 hour. Let me give you an example. I was trading the market when that spike that I showed you happened, and all of a sudden things change, right? I have to switch onto a small time frame. I was looking at a 1 minute time frame, just to give you the scale on the movement there. Typically, when the market is in normal condition, the market moves per point. Simple as that. But yesterday it was unique. The volume was so high at first, and then the volume kind of died down. But every tick, every changes in the market last night, especially in the stock market, if you take a look at the indices, you're not going to be able to look at it even on the 1 minute time frame. You're not going to be able to look at it. But if you're trading live and you understand what's going on last night, heads up if you're doing that. But it doesn't move 1 point at a time. In fact, it actually moved 50 points every tick, right? So every price changes that happens in the market, it's actually 50 points. So if you're looking at the tick chart, it was basically just gapping up every single tick, right? It's not moving, per point. It's really jumping up 50 points. And that's a lot. Even if you trade a normal contract size last night, let's say, we were taking an example on the US 30 because that's $1 a point. Simple to kind of understand, right? If you are trading $1 a point, which is a contract size, and all of a sudden the market doesn't move $1 at a time, it started moving $50 at a time, right? If you get it right, of course, you're going to be rich really, really quickly. But if you get it wrong, that's negative 50 every time the market moves, right? So every time the market moves in one direction, it's negative 50, negative 50, negative 50. And that's how it was achieved. The movement in the market was so quick. It's crazy. And the volatility in the market was so huge yesterday that every point, every tick in the market that moved, it's not even a point. It was 50 points in the Dow Jones. It was 50 points in the NASDAQ. It was about 10 points on the S&P 500. It was crazy, right? So just a little bit of a general rules there. make sure you understand what you want to do with it. You want to stay in the market for too long, you want to stay in the market very, very quickly. In fact, yesterday I think I had one of the shortest trade in my life. It was 10 seconds. And I got in, clicked it, and I have to click out. The moment I open the positions, before I can even think about anything, I already clicked my positions because it was profitable enough for me to get out. So just make sure you know what you're doing and what you are planning to do with or after the news release. Okay? All right. So how do we tackle news releases? We typically use the buy stop and the sell stop orders and the sell limit and the buy limit orders. Now, the buy stop and the sell stop orders are very simple in terms of nature and what they are. With the buy stop and the sell stop, let me just explain this very quickly, right? With the buy stop are basically order placed above the current market price, and if you expect this resistance to be broken, and you expect when resistance to be broken, you want to enter into a long position, then you use a buy stop. If you think the support is going to be broken, then you use a sell stop. And if we look back, how do we take advantage on the accumulation phase? How do we take advantage of a range-bound market? Because a range-bound market happens, it happens, and it's very well defined by a support and resistance that keeps blocking the market from progressing any higher. So the logic here is that when it comes to news trading, when the news moves the market, it will go in one direction, because you don't know which direction it's going to be. And if you see the market accumulates itself, then you can use a buy stop order and a sell stop order at the same time. All right. So let me give you an example here. So this is the buy stop and sell stop strategy, or what I call the straddle strategy. We have that accumulation phase. We have that corridor of volatility. We saw the market move in a range-bound market condition. Right. You look at that and say, hey, that's a range, right? So I'm thinking something's going to happen, because the longer the market stays like that, the more the higher the pressure is. And we all know that anything that's compressed with a high pressure eventually needs to kind of let go of that energy, right? So if you take a look at the corridor of volatility here, you create a buy stop, you create a sell stop. I don't know what the news is going to do to the market, but it will move and trigger one direction in the market. So if that happens, like this one here, the market just shot up, right? The market just shot up. And you thought this is just an example that we cherry picked? No, I can give you the example on the same trade yesterday that we saw just now with the spike there. So we saw the market just shot up like that. And we're not missing out on the position because we have a buy stop up there. We know the rally is going to be so strong, it's going to move. I don't have time to react manually. And a couple of reasons for that, why we use the pending orders. Because I might doubt myself when the markets start moving. I might not open my position, and that's basically what it is. It's just not every trader wants to admit it. Or the other thing is, I might not be looking at the chart at that time, and when I click, it was too late because the market was moving too quickly. If you had a stop orders, then it's going to get filled automatically. Simple as that, right? So the strategy here is that if one of those stop orders get triggered, like in this case, the buy stop got triggered, we are in a buy trade, you need to cancel the other orders, right? You need to cancel the sell stop. Simple as that. And you can see how the market rally up really, really quickly. And that's when you can start moving your stop loss to break even. And I highly recommend doing this a lot, because the logic here is that, hey, if I'm able to move my stop loss to break even, if the market reverses on me, I'm not losing money. It's a risk-free trade. So every single time you see the opportunity like that, when the market moves in a volatile way, in a very dangerous way, I would say, then yeah, always trying to protect your equity first. And every given chance that you're able to turn a trade into a risk-free trade, I say take it. Because at the end of the day, what do you have to lose? If it's at zero, you lose nothing. Simple as that. There's a lot more to gain. So these are one way to take a look at a buy stop and a sell stop strategy. So let me just give you an example here on a buy stop and a sell stop strategy. Okay, so take a look at this one here. I'm just gonna zoom in very, very quickly back onto the small time frame here. and I want to go into the 1 minute time frame, and I want to show you what happened before the breakout happened, right? This is going to take a while, but let me just scroll through. There we go. All right. So let me just clear this out. And you can see a couple of things here. Before we saw the market breaks to the downside and then snap back to the upside, you got two things. You actually have the corridor of volatility, which is actually this, right? So you can actually have a buy stop up here, and you can actually have a sell stop down here. So if the sell stop initially was triggered, then the market went down about 700 points. If that was profitable for you and managed to get out, that's fine. But if you didn't manage to get out and you move your stop loss to break even, then when the market snapped back to the upside, you're completely fine because your stop loss is at 0. So that's one thing to look at. Now, before that run happened, the market kind of pauses for a little bit. So let me just zoom in a little bit here. So the market pulled back up, right? And before that run to the upside, do you notice what the market is actually doing? Is actually in a holding pattern again. It was actually forming a little bit of a consolidation here. So if you take advantage of that, and you had a buy stop yesterday, right? You don't know what it is, but you know what's likely going to move the market. That was probably the biggest trade in your life in one single, in one single 10 minutes, because the market just shot up. Literally, it broke out. So if you had a buy stop order, I mean, it will be triggered here, and within 1 minute, 2 minutes, 3 minutes, 4 minutes, 5 minutes, 6 minutes, 7 minutes, 8 minutes. Within 8 minutes, it would have net you 17,000 points. You might not get exactly at 17,000 points because when you see the market rallying up like that, 840 points is enough. Maybe you're targeting 1,000 points. It's okay, but it just moves really quickly, And if you move your stop loss to break even, that's completely fine because when the market moves back, it just hits your stop loss at break even. Nothing happens to it. Okay, but you need to cancel the other order because if you didn't cancel the other order, what if the market goes down a little bit lower? It might actually trigger your stop loss, right? Sorry, your sell stop. So you need to be very careful. So there are ways to look at that. You can trade it on a 1 minute time frame. It's completely fine. And the 5 minute time frame. And let me just zoom out a little bit and show you what's going on. You can see what I'm trying to point out here. This is on the 5 minute time frame. And the 5 minute time frame throughout the whole day, it was actually in a range bound market condition. So the market just broke out. Just rally up to the upside. We could look at that, and you can have that buy stop and sell stop. So every time you see the market flatline, that's basically when we want to have a buy stop. That's basically when we want to have the sell stop, right? Simple as that. As simple as that. That's how we trade the news here. So right now, can we do it the buy stop and sell stop? No, we're doing something different here. What are we doing here? So let's continue on to the slides, right? The next thing that we want to look at is actually the buy limit and sell limit strategy. So the buy limit and sell limit strategy is looking at the previous highs, right? Previous resistances. And, you look at that and say, I think that's going to be a tough resistance. I think the market is going to fail there. So I want the market to go up. And when it gets there, I want to sell the market. And there's actually a very good example that's going on in the market right now. But, let's take a look at this. We're looking at a local previous high, and we set a sell limit order. And when the market hits it, the idea here is that when it hits that resistance area, when it hits that order block, when it hits that liquidity pool, when it hits that supply zone, whatever you want to call it, you want to have a sell trade that's triggered. You might not be in front of the computer. You might be going to sleep or whatever. You might need to work. You can place this and then live it, right? So when the market hits that, you don't have to be in front of the computer. You can trade it, right? So can we do a limit strategy? Yes, we can actually do a limit strategy on this one here. In fact, I can show you the example on the same day yesterday on how the limit strategy works, and the example for potentially tonight as well. So if you take a look at this one here, we have a sell trade. We're looking at a resistance because the sell limit is basically when the market hits that high, it'll start opening up a sell position, right? So you're going against the market, but it hits and then immediately crashes to the downside. Now, If you take a look at it on the examples here, what are we looking at here? Just, what kind of area are we looking at? If you take a look at where market was before it kind of crashes down, it was basically here. So we're actually around the area over here. A lot of traders yesterday, and that sharp rejection from here, sure, it was a clarification that the fake news was there, but what if everyone was just looking at that and saying, that's the middle of the block that we have there, that was previously a support area, and a lot of traders place their order. It's not exactly at 39,200. The exact number is actually 39,810. So about 39,800. So 39,800. So 38,800. That was actually the level that a lot of traders placed their order yesterday, right? It's 38,800. What happened was the market pulled up, hit their sell position, and then immediately came back down. And those people are going to be profitable, okay? And if we look at the current situation here and we try to find resistances on what's going on, if you take a look at the crashes in the market, that's a huge crash in the market, right? You can do Fibonacci, right? You can do Fibonacci analysis here. What can we do? You might thought, okay, this is still continuing to push up. We see a little bit of a failure here before it crashes down. So maybe about 50% there. That could actually be our sell limit, right? So I might place a sell limit here at 39,565, and that's basically it. We place a sell limit, and if the market hits 39,565, it will start selling. And maybe your target doesn't have to be a new low. Maybe you're just targeting the support area that we have yesterday before the market kind of rally up. I think that makes a lot of sense, right? So you can set your target there if you want to, set your target here at the previous low. That's going to net you a lot, because if that trade was triggered, your stop loss is probably going to be not too far away from this area here, right? Your stop loss is probably just going to be about here. So if I were to get rid of the fib, right, and show you what's going on here, let me get rid of that. That's basically your risk. This is your risk in the market. Look at your risk in the market, and your risk in the market here from that point of entry, it's only 333 points. But if you get it right, and if some traders are probably going to get it right, they are looking at a 3,000 point gain in the market. So do the maths, right? It's 10 times the risk reward ratio. So we are looking at a risk reward ratio of 1 to 10, because you're risking 300 and you're trying to earn a potential 3,000. So we're waiting for this, and you're looking at the market looking a little bit exhausted today. So it might actually fail at that level. It could actually fail at that level. So I think this is viable. Now the difference here is compared to the stop orders that we were looking at just now, because you're placing your order very close to a resistance area. Your risk is actually very small. Your stop loss is actually very small. This strategy here, the sell limit strategy and the buy limit strategy, if you take a look at the example, the stop loss is very small. And that's the key to the difference between the sell stop and the buy stop here. You take a look at this one. The stop loss is still a lot wider. This one here, you're looking at a risk reward ratio that's obviously beyond 1 to 3. We are looking at 1.5, 1.10. That's basically what happens with the buy limit and sell limit strategy. Of course, it does have a little bit of a drawback as well, because you're countering a movement in the market. There's a risk that the market could just hit your sell order and then immediately it runs up and hit your stop loss. It could happen. So if you don't understand technical analysis, I would say avoid this. But if you understand price action analysis, you understand market structure, you understand liquidity in the market, then this is actually a very good strategy to be employed during news trading as well, because you don't actually have to be there before the news gets released. And if the news gets released, hits your order, it might reverse, because it's at that extreme point. It makes a lot more sense from a technical perspective, right? And these are the two trading strategies that people use when it comes to news trading. It's very simple. Okay. So you can also trade after the news is released, right? You can wait for the market to kind of make that, make sure that it doesn't destroy the market structure. It creates a couple of swings, so you get your new stop losses, you plan your trade well. That's completely fine as well. And typically after the news, a lot more people are actually going to be using the limit orders. During news releases, people use the stop orders. But after the news gets released, people are going to be using the limit orders, okay? All right, so before we wrap up for tonight, and also if you have any questions, please fire away, but I'm going to give you guys a quick test, and I'm going to wait for an answer for that. I'll give you guys 2 minutes. All news can be divided into two categories. What are they? And what type of orders is most often used in news trading? And by now, as for tonight, what type of pending orders do you know? And when should each type be used in trading? Okay, so I'm going to give you guys 2 minutes, and hopefully I'll get an answer from you guys. Okay, looks like, is everyone coming? Yeah, someone answered. Penyo channel just answered. Pending orders, buy stop and sell stop in ranging market before the news. That's right. And that's when you should be using those trading strategies. And that is also the answer to the second one. It's the type of orders that is actually most often used in news trading, right? And the logic here is, if you have attended our live trading sessions before, we were looking at a couple of currencies and a couple of assets, and we say, hey, this is tradable. That's not tradable. We're gonna skip this tonight. We're gonna trade this tonight, because if I don't see that corridor of volatility, I'm gonna skip. Simple as that. Because without that corridor of volatility, and you try the buy stop and the sell stop strategy, it's not going to work. You're actually lopsided, as in it's not balanced. Right? What if it hits and it reverses and it goes the other way? You don't have a backup plan, Or what if it didn't hit your, for example, you have a buy stop. What if the market just went down? You don't have a sell stop prepared for it. Now, if the market doesn't move in a range, we just can't trap the market like that. We can't use that strategy. As simple as that. So that buy stop and sell stop strategy is what we call a straddle. It's a very old school strategy. Right? It's a price-based strategy. Some people used to call it naked trading, basically trading without charge, purely on price. And that's very old school way of trading. And that's basically what people use to trade the news. It's not something fancy or anything like that. It's simple logic. If it doesn't break out of the range, you don't trade. If it breaks out of the range, then go with the flow. As simple as that. Okay? All right. All news can be divided into two categories. There's also sell limit and buy limit. Yes. The sell limit and the buy limit, let me explain to you on this one here. We typically use that after the news. It's very, very rare that we use a limit orders before the news, right? But once the news has been released, you can start reanalyzing the technicals, and that's where you find, okay, hey, the market just hit that resistance, it failed, Okay, let me just place a limit order again at that resistance, like just the example that I showed you just now, right? Because it hit that resistance yesterday around this area here. Some people are actually already shorting this at 39,000 because this is a psychological level. And if in the next 2 hours the market crashes down, because right now it's actually severely overbought already from the relief rally that we have. There's actually a higher probability that the market could actually crash back down tonight and potentially even crash down even lower. So that's one way to look at it. But we use the sell limit and the buy limit strategy typically after the news has been released. Okay, so it's not during news releases. Okay, again, all news can be divided into two categories. There can be the hot unexpected news, and I want you to prepare yourself mentally. As long as Trump is acting up and turning the whole world into a circus, then yeah, every single day you should be anticipating unexpected news. Every single minute you trade, you should be expecting unexpected news. No one expected the news on the fake news, having Trump pausing a 90-day and still being investigated. Who's posting that? It's not funny yesterday, because everyone was already jittery enough, because that was a global meltdown yesterday. And in terms of scale, it was much larger than the Asian financial crisis. It was much larger than the global financial crisis. It was much larger than COVID in terms of the range, in terms of the speed of the meltdown yesterday. And in fact, as a comparison here, the Chinese market was closed end of last week. It was reopened yesterday. And if you know the Hang Seng, which is the index in Hong Kong, the drop yesterday matches the drop during the Asian financial crisis, which is in the late 90s. So it was a huge deal. We were looking at the market potentially heading into a real meltdown. But then the fake news happened, and within 3 minutes, market was rallying up 2,000 points, and then the next 5 minutes it reversed down because it was verified to be fake. So this kind of news here are unexpected. You just don't know what to expect in the market, especially around areas where everyone is on the edge and there's a high volatility in the markets. Just keep that in mind, okay? And obviously the other one is the scheduled news. Those are scheduled releases like the CPI, the NFE, the GDP. Those are the ones that we can predict to a certain degree. We have the consensus coming out. So if you want to know what's going to be released in a week, I normally talk about this on the Outlook that's published every Monday. So, start watching that Outlook. Okay, so that's the old code. So I'm going to give you the new code. It's not from 2025, but yeah. We got about a minute left. If there's any questions that you want to ask me about news trading, feel free to ask away. All right. Well, doesn't seem to be any questions that we have tonight. So yeah, next session is going to be our CPI numbers. It's going to be on Thursday, and we'll hopefully. I doubt that we have enough to go through a lot on the theory side, so I'm probably going to skim through a lot on the theory side. But I think there's a lot to talk about the inflation numbers. That's going to be on Thursday. So yeah, come in on Thursday and I'll explain to you the context of what's been going on in the market. Obviously on Thursday, this is actually very important because it's actually on the 10th of April, right? The reciprocal tariff that's going to be applied to the world by Trump is actually going to start on the 9th of April. So we will have a different market after the 9th of April. We have a new global market that has changed after the 9th of April. So it'll be very interesting. So tune in on Thursday and we can discuss that as well, and also the impact on inflation in this kind of market. How is that going to impact the movement in the market, and what the FOMC is going to be doing based on whatever's going on in the world there. How about the market execution with the trading stop loss? Yeah, you can do that, but are you able to create a pending order with a trading stop loss? I think you can do that. But trading stop loss, it's really a matter of preference, because how are you going to calculate that trading stop loss? And I think the trading stop loss, the basic one, if you don't have a custom indicator, it basically trails the movement by every point, for example. So I think it's good, right? Especially for news trading like that. Use the trading stop loss. It will lock it up. So the example here is that if the market move 10 pips, for example, in a currency, you set your trading stop loss at 10 pips. So every time it moves 10 pips, it moves your stop loss up by 10 pips as well. So, it's always a good idea to use this trading stop loss. But you need to be able to figure out how to use the trading stop loss. Because if you use it wrong, you might exit the position too early because you're not really giving room to move in the market. But if you're not sure in terms of where your stop loss is, then yeah, I would say if you don't know your exit, if you don't know where the market is going to go, and you don't know when to get out, if anything happens to your trade, then I would recommend a trading stop loss. Then you don't have any excuse. I'll just follow whatever the market is doing. So yeah, it's a really good idea in terms of the market execution and then using a trading stop loss. Yep, that's completely fine. With news releases, the reason why we use the strategy like that is because sometimes we just can't react to 4 different currencies at the same time during news releases. And that's why we use this strategy here, because when we trade news, we try to get as much opportunity as we can, just leveraging on that short-term volatility. All right, so hopefully that answers questions. But yeah, next session is going to be on the 10th for the CPI. Good luck with your trades for today and tomorrow. It is going to be extremely volatile, especially on the 9th when tariff kicks in. Just be mindful on that. I'll see you guys on the 10th. We'll be in a completely different world on the 10th of April if Trump doesn't pull back on his tariff. Okay, good luck with your trades. Expect extreme volatility this week, and I will see you on Thursday. Stay safe.